Tuesday, December 13th, Guy Adami, Dan Nathan, market call, 1 p.m. We're 5,000ing a little early today, folks. Just so you know, probably about 125-ish, as Dan's got some important biz, as does G Swizz. But this is Market Call, today sponsored by CME Group, Dan, where risk, in fact, meets opportunity. And our partners at FactSet, both our sponsor and our data provider, they continue to get it done for us. Dan Nathan, I will tell you, every once in a while you have these days we got a bookmark. You got to get one of those trim tab things and put it on the page. Well, today appears to be that type of day.
I mean, listen, you and I, we were speaking earlier this morning. The data comes out. I don't think it's a big surprise. We have this Fed meeting tomorrow. We know that the CME Fed Funds futures are pricing a near certainty of a 50 basis point increase. We know that the last four meetings, we've seen 75 basis point increases. Has been the largest pace in which the Fed has raised interest rates in a very long time. And here's the thing. The fact that we have the CPI data this morning, Guy, and it's a little softer, and that the S&P futures are literally bid up 3% like that. You see bond yields going the other way. I think we have a day chart here of the S&P, which just really shows the hair trigger action. You like to use that term every once in a while. I mean, investors want to, shoot first, ask questions later. I mean, that's just a one-day open at the highs. Here we are making new lows, about to go red on the day. I mean, what does that sort of behavior, investor behavior, speak to you?
Yeah, well, that's a great question. And is it, and I'm not trying to be glib here at any stretch, it's actually a serious question, but is it truly investor behavior, or is the market become held ransom to these algorithms that pick up headlines and basically trade off them? So yes, I mean, they're clearly animal spirits at work without question, but there's also some semblance of, the machines have taken over in the equity market, because that move earlier today, obviously, it immediately up 115, I think, S&P handles.
Yeah.
Didn't make a lot of sense to me, given the number. I mean, the number was softer than expected. But again, when you're still talking about a 7.1% read off that peak we had over the summer of 9.1%, it's not like inflation is cratering or the rate is cratering. It's moving down orderly, but I don't think nearly as quickly enough. So I think what the market is trying to recognize now, that perhaps human beings have come back into the equation, is you still got a Fed meeting tomorrow. I think we know what's going to happen, to your point. But the questions and then the subsequent answers, given the fact that the market is at these levels, is going to be really interesting to see how Jerome Powell navigates it. Because I will tell you, they don't want asset prices elevated. I mean, they've basically as much as stated that. And over the last 6 to 9 months, they paraded dozens of officials out to say exactly that same thing.
Yeah, no, exactly. And, you just mentioned the levels. I mean, let's look at the S&P 500, the futures here. Let's look at a one-year chart. We know the downtrend. I think we can all see it in our minds. If you're listening to us in your favorite podcast store, you know what we're talking about. It is a series of lower highs and lower lows. And we got through that downtrend that's been in place since the second or third trading day of this year in January. Briefly, it looked like a big gap. The fact that we have reversed that, and now we are basically right on the 200-day moving average below that downtrend. If the Fed comes out, and to your point, Fed Chair Powell does really not want to see the S&P 500 down about 15% on the year, given how much they've raised interest rates. It would say that there's something broken, Guy, between the mechanism of yields, right, and asset prices, because what were they trying to do by raising interest rates? They were trying to tamp down asset levels and valuations, and actually it would prove that they weren't that successful.
Right.
They popped bubbles like crypto and PFPs of Bored Apes and this and that or whatever, but they didn't do the stock market yet. And you could also make the argument, given how much the housing market ran up over the last year and a half, right, into the rate increases, that housing is barely off of its highs, even though it's down at least 10% in most parts of our country.
Yeah, and throw the other factor in there, the job market remains strong as can be. You continue to see wage growth, albeit somewhat muted, but you're seeing wage growth. I mean, all these things are basically counteracting what they're trying to do. So in their mind, they say, well, at least the CPI is coming back down. That 9.1 print was atrocious, but, we've been moderating, moving lower. Effectively, if you think about what inflation is, it's a rise month over month, year over year. Effectively, we have no inflation if you really want to break it down, because the month over month is basically in line. The absolute rate is a bit of a concern here. But with a strong job market and now commodities seemingly taking their cues from potentially this interpretation, That's just going to make their job that much more difficult. And we've said it for a while. This was never going to be an easy thing for them to navigate, and I think we're seeing it happen right before our very eyes.
Yeah, so you've been spot on in what the kind of 2-year treasury has done. It's really it just hasn't budged a whole heck of a lot. Here we are at 4.2, but the 10-year, at 3.5 right now is kind of interesting. We have a 1-day chart of the yields here, and if you look at it, the knee jerk again was yields lower. They're coming up a little bit off of that low made, just after the opening today. But if you look at it on a 1-year basis, and again, I think you and I were in clear agreement that we thought that we'd see 3.5%. I actually think that we see, if you look at this 1-year chart, I think we see 3% possibly, maybe by year end, man. I mean, because here's the thing: if Fed Chair Powell comes out tomorrow and just said, yes, the rate is going to stay elevated, we're not going to be raising rates aggressively. And again, if you want to throw up that CME Fed Watch tool, you look at the near certainty of 50 basis points tomorrow. The next meeting is going to be on February 1st, and it's showing the potential for another 50. If we start to see data, if we see unemployment rate tick up a little bit, and we're going to get that in early January, and some other data that suggests softening inflation, then you're going to see that start ticking down a little bit, right, guys? Like the expectation would be maybe a 25. That's what we're going to be battling over come New Year, is 25. And at that point, I really think you're going to have the 10-year yield down there near that 200-day around 3% or so.
Well, that would speak to an extraordinarily slowing U.S. economy, I would think. And again, you've made this point, but it's important to make it yet again. Even if they were to, let's just say it's 50 tomorrow and 25 basis points next meeting, and that's it for the year. There's this belief, I think, that somehow in the back half of next year, rates are going to start going lower, or they're going to start taking rates lower. And I don't think, if you really listen to what they've said, that's the case at all. They've talked about being elevated for a longer period of time. And there's a cumulative effect to the economy that takes place at interest rates at a certain level. We obviously saw one side of it when interest rates were zero for a decade or so. We're starting to see the other side of it. And then people are coming to the realization that slowing growth means slowing earnings, means slowing revenue, and it's going to hurt margins with again, a CPI rate that's probably going to still be hovering in the fives in the middle of the next year. So it's a problematic thing. And I don't think let's put it this way: the market rally this morning was not commensurate with really what's going on in the world, in my opinion.
Yeah, no, I agree. Yesterday, I just want to touch on this really quickly because we talked about the NASDAQ 100, and we're going to look at the NASDAQ futures right here. Guy, you look at that downtrend, you look at the 200-day moving average. It has not reached the downtrend. It has not touched the 200-day. And I do think that the relative underperformance of the NASDAQ off of those October lows to the S&P is really interesting. We know why. There was this rotation into growth, into value, right, which really benefited stocks that look like the names in the S&P 500 or in the Dow. And the Dow at one point last week, guy, was down only 6% on the year, which is pretty remarkable. But the VIX was telling us a story. We highlighted this yesterday, and we know that sometimes the price action of the VIX after a weekend, you see that kind of Monday pop or so, but it really remained elevated despite the fact the market looked like it was hoping for weaker data on the inflation front this morning, which would cause the sort of rally or some sort of rally that we had today. But look at the VIX. It's still hanging in here. I've been long calls. I detailed it last week on the market call. And, I rolled those into some weeklies this week because when the market was up 3% and the VIX was down near its lows, down more than 10%, I said, man, I don't know how you buy this into the Fed tomorrow. So I didn't think we were going to give up the whole thing. But at this point, it looks like we are going to. And the VIX is going to stay bid into tomorrow because now just saying in general. And if he is hawkish, you're going to see this thing above its 200-day moving average, probably in the mid to high 20s. And that
I totally agree with that. Yesterday, when we talked about potentially yesterday being a bit of a tell, and obviously the VIX is off a little bit, but it's grinding back. And I think you're right. Hawkish, again, the statement will be what it's going to be. I don't think the statement is going to be changed in a meaningful way based on this number today, but it's the answers to the questions. That's when the market really moves. It's the back half, that last half hour, those pressers where questions are asked and answered in such a way that the market takes its cues from. Real quick, Dan, we have a question from Mike. It's either placid or placed, so I apologize. And he says, why compare the 2s, 10s when 3-month to 30 years is negative? You have inversions all throughout the yield curve, Mike, without question. You're right. I mean, we could look at a number of different things. 5s, 10s, 2s, 10s, 2s, 30s. There are any number of different things around the yield curve that have gone negative. And again, regardless of what you pick, it doesn't speak to a robust economy, and it certainly doesn't speak to a market that should be trading at basically an inline historical multiple, probably right around 18 and a half times next year's numbers, if you think about it right now, Dan.
Yep, no doubt about that. All right, aside from Guy, the reversal in the broad market today, the most interesting thing that I see, and they might be related, but maybe you can help figure this out a little bit. Crude oil is having a day. It's up
Yeah, it is.
3%. You're seeing the OIH, the XLE. These are two ETFs that we talk about a lot, the oil services and the XLE, the large integrated here, and they're bouncing. But, it's interesting that, we saw crude up right out of the gate, and then I saw this headline from OPEC. Did you see it? They said they're cautious on demand heading into the new year.
Right.
And then put that all together. Maybe these guys can throw up the JETS chart. That's the ETF that tracks the airlines and the big components. You know what they are: United, Delta, Southwest, JetBlue's in there, American, the others. And that thing's getting murdered today. And that's one that, I've had this bearish position on here a little bit. I thought the demand was going to be weak based on some of the things that we heard from Booking and Expedia over the last, let's call it, month or so. But this is not a great price action today in these airlines. And then when you look at crude, maybe found a bottom here. Talk to me. Let's pull that crude chart back up.
Yeah, let's look at the crude chart. Yeah. And the headline is interesting. So OPEC urges caution, cuts first quarter oil demand. I mean, that's basically giving them runway for further production cuts, I think, in my opinion. Again, I'm not trying to game this out or sort of talk my dogma, but you've made this point for a while. You said last week, in the middle of last week, you don't really like to press a position like this on the short side in terms of crude oil, and that proved to be correct. Now you're seeing the bounce, and what does it mean? If you're going to start seeing production cuts again, and we're going to have Halima Croft, by the way, on the On the Tape podcast this week. It's going to be fascinating to see what she thinks about the energy market, but these energy names have been resilient. Yes, the OIH, I think, traded down about 278 or so. I think the XLE that you put on traded off as well. But they're all starting to get back on their horse again. And what does it mean? Again, energy is such a huge component of inflation. And again, anything interpreted as dovish is just going to set these commodity markets, in my opinion, back towards the upside.
Yeah, well, you've been saying that. And I think that's interesting. I haven't had a strong opinion one way or another, especially when I was still bearish of both of them. But now that I've taken off, it does make some sense to me, which actually leads us to the dollar, the US dollar index, the Dixie. And when you look at this thing here, you kind of have to say to yourself that, okay, why was the dollar so strong, relative to, okay, let's say the euro? When we look at the Dixie, 50% of that basket is the euro. Well, we get it. We got what was going on right over there. And then you look at some of the other currencies and the pressures, on the Chinese yuan, and the list goes on and on here. Well, the Dixie is very near 6-month lows, and it really feels like it's peaked. You and I have been saying that long-term yields have been peaked. We know the correlation between the two of these, but this should be really good, I think, for commodities, specifically energy.
Yeah,
oil.
and we should, right, this weakness in the dollar should, and I think it's proving to be, if you look at the move in precious metals today as well, but this also should be a level of support. And it's interesting, Gary made a comment on the chat that call on treasury rates going lower does not suggest higher crude oil. That's true. I know exactly what you're saying, except they are mutually exclusive right now. And crude oil's come down significantly, and you still have supply-demand fundamentals that are out of balance. I mean, there's still a supply problem on the crude side. So I can actually reconcile dollar going lower, rates going lower, and crude oil going higher. And to a certain extent, you're seeing that today. So, that's what makes this thing so difficult. We talked about it with Peter Bookvar a couple of weeks ago, and we talked about it, I think, on the On the Tape podcast that dropped on Monday with the gentleman from Fidelity. I can't remember his name. I apologize.
Urian Timmer.
Urian. And we talked about this scenario where, again, you have lower rates, lower dollar, higher commodities, and what does it mean for valuations and stuff? And it's playing out, Dan. It's just a very confusing time. And, you're taking aspects of markets from the 1920s, 1950s, as he pointed out. He made reference to the post-World War II, talked about the 70s and the 80s. So there's something for everybody in this 2022 market.
Yeah, here's something that until recently has not been for everybody in 2022, Guy, and that's gold. And you've had a nice call off the bottom here, and I think the reasons in which you thought it should work. You've been in the camp that the Fed kind of lost control about what they thought was going on with inflation last year. They stayed their welcome way too long on the easy monetary, and that's also really clear. The uncertainty about what's gone on with COVID zero in China and the supply chain disruptions, and oil and the supply chain disruptions from the war in Ukraine. Okay, those were all, not something that anyone could kind of put their finger on here. But gold, your view is that at some point, all of those things that I just mentioned, including the Fed waiting too long, is going to cause something really nasty on the other side, right? A weakening economy. And that's the very thing that might cause people to look at gold again, especially when the kind of gold digital doppelganger, Bitcoin has just lost all interest by most institutional clients. Gold should start to work. It's working. You see that uptrend that's been in place. It's contending with this 200. Is there a move possibly into the new year because people said, okay, let's go back to the thing that makes us feel better in worse times geopolitically?
Yeah, I'm going to be careful here because I do think the answer is yes, there's a move lined up. But again, if he's overly hawkish tomorrow, gold will probably give back its gains of the last week or so. So with that caveat, the answer is yes. I think gold has a place here. And if you look at what's really happening, central banks have actually been buying gold. Chinese have been actually selling U.S. treasuries and buying gold as well. And I don't know if we can do this on the fly, but if you put up a silver chart in the form of SLV real quick, you'll see again that silver is another one of these things that very quietly is going from about 18.5. I think the current level is about 24 or so. And, this seemingly is off to the races as well. So there you go. I mean, the precious metals are starting to catch a bid, and I think it's suggestive of all the things we say. I think people are finding value here in things that were left for dead 4 or 5 months ago.
Yeah, well, here's one. Today, they're finding a little value in the aforementioned Bitcoin, and again, here's the futures here. These are listed on the CME. You see our nice looking fact set chart here. That very well defined downtrend from the highs, late last year. We've really been basing here, and you see the resistance, at the current levels that we're just below. But again, basing. I mean, until we kind of meaningfully get above that kind of level here that we've been in for the last, I don't know, month since the breakdown below like 18,000 or something like that. I just kind of really find this thing, especially given the headlines with, this Sam Bankman-Fried. Hey, first of all, Guy, Sam Bankman-Fried, we did a podcast with the sponsor or one of the sponsors of our fine market call here on Tuesday, Terry Duffy, the CEO of CME Group, detailing, and he has receipts for all of it, calling out SBF as a fraud back in the spring. Was that back in March, I think?
Yeah, it was in March. It was in front of Congress.
Yeah.
And he absolutely called him out. He made all the cogent points. He tried to explain to Congress what was going on. Ro Khanna from California clearly didn't want to hear it. He has subsequently, what I've come to learn, he has apologized in the form of, Terry, you saw things that I didn't see.
No way.
That's tantamount to
an apology. Why did he do that? Did he do that publicly?
Apparently that was done not in a public fashion, but he reached out to Terry, from what I've been told. I mean, we'll see, whether that comes out or not doesn't really matter. I think he's actually addressed that in terms of the media last time he was on CNBC, Ro Khanna, that is. But with that said, so many people just really didn't want to hear what he has to say. And that's really a function of this cult of personality, which was the title of a podcast a few months ago. People want to believe in certain things. We saw it with Elizabeth Holmes at Theranos. Yeah. To a certain extent, you saw it with Bernie, what's his name? Bernie Sanders. Bernie, help me. Madoff. And you're seeing it here as well. So, and people just don't do their due diligence at all because they figure if this person invested in that guy or gal, they must have done their work. But your point about Bitcoin, I mean, it did get off the mat a little bit today. And I was never a believer that this Sam Bankman-Fried thing was an indictment of Bitcoin. It was an indictment of Sam Bankman-Fried. I don't think it was an undermining of the asset, but people will, again, they'll interpret it any way they want.
Well, it's an undermining of the asset for the standpoint. A lot of people who are trying to look for like institutions that were kind of gave them confidence, right, in transacting in it,
Hmm.
investing in it, holding it, custodying. The list goes, lending it out. I mean, the list goes on and on and on. Being able to represent, if you're an institutional fund manager, that you have all these processes in place, and that we can invest your capital in this. You trust us. The trust has been really broken, especially when you consider all the VCs who are actually venture capitalists who are investing in Sam Bankman-Fried's, not his hedge fund, that they were diverting capital to. And that's not me saying that. That's the complaint, where he was just arrested, saying that they were, like, almost from the get-go, diverting customer assets and putting him into his hedge fund. And that's how this thing got built. I mean, you lose that sort of confidence, guy, altogether in a brand new asset class, which has really, been around for a little 10 plus years, but institutional adoption of it in just the last few years, it's hard to come back from that. And the fact that, Danny Moses on the tape has said this numerous times, the fact that Bitcoin is not like single digit thousands, is not like trading at 6 or 7,000, actually is kind of bullish. But the fact that it can't get off the mat meaningfully
Yeah.
and break out, above these technical resistance levels also says something.
Yeah, tomorrow again. We keep bringing up tomorrow, but hawkish tone out of the Federal Reserve again in the form of Q&A. You're going to see Bitcoin give back whatever it gained today, and probably a little more so, because one of the points I've tried to make, sometimes elegantly, sometimes sloppily, is the fact that Bitcoin was born out of this fear of central banks run amok, and it's no coincidence that again Bitcoin topped out this time last year when our Federal Reserve pivoted. That's not coincidental. So if central banks are trying to get their collective act together, I think Bitcoin has a ceiling. If central banks bend or pivot or flinch or blink, whatever word you want to use, I think that's the next leg higher. And to a certain extent, you saw some of that earlier today. You saw what could happen. But again, it really comes down to this time effect, or 25 or so hours from today.
Well, listen, here's the other thing, man. This could be just the tip of the iceberg as it relates to fraud. I know a lot of people are focused on some other exchanges, some other stable coins. There's a lot of, noise around Binance. I don't know anything about it. I can't tell you that there's any credence to some of the allegations about it. But, if there's one after another start to go down, I mean, that's the scenario where, the underlying, and it is Bitcoin because it's the market cap leader, that's the thing that is just, going back low. I've never been a fan of Bitcoin. I don't like the religious nature of those people who've been pushing it for all these years. It doesn't seem to solve any of the purposes that they suggest it does. And to use your phrase again, the cult of personality, it's the cult of the thing behind it. I mean, think about this. When Elon Musk in early 2021 was pushing Dogecoin, he put Bitcoin on the Tesla balance sheet. He was, like revving up the meme stock stuff or whatever. It was all wrapped up into one, man. And that's just lastly, before we get out of here, can we spend a couple minutes on
You
this?
got to look at Tesla.
Yeah, you got to look at this thing, because to you and me, on Tuesdays, we spent a lot of time talking about, macro products that trade on the CME. But this is really important from a sentiment standpoint here. This was a $1 trillion+ market cap stock. Elon Musk, the CEO, founder, richest guy in the world. Look at this. This is a tech founder. This is somebody that people follow. This text or this tweet was sent to me. This guy is embarrassed to have a Tesla. He sold it. Okay. You're seeing a lot more of this thing. And look at what's happening with this stock. We highlight this 140 level. That is when the S&P stated on November 2020, that 2 years ago, that they were going to put this stock in the 500 index. It doubled in the next month and a half or so. It's round tripping that entire thing. And, Tesla, largest shareholder, Elon, he's becoming a detractor for the brand. He's got tons of his shares. The largest shareholder of 14% pledged for Twitter, okay, and for all the debt to buy that. He's supposedly selling secondary of his SpaceX holdings, which is trading at 50 times sales, guys. So talk to me about the sentiment in and around this, especially along the time that we're starting to see things like SPF. I'm not saying there's any fraud here by any means, but we're seeing a lot of nastiness wrapped up into one guy, and it seems to be coming undone a little bit.
Yeah, I mean, we just try to game things out, looking at the stocks and where we think things can go. And we've said for a while that ultimately $150 is a level that Tesla's going to find a home. And here we are. Now, it's done it with fits and starts. I mean, we traded down to that 168 level or so, traded back to 200. But we said that was probably going to be a rally to fade, and that's proven to be correct. And you have to wonder, if Tesla, the stock, were to continue this move, and now it's, I think, 60% off its all-time high or something around those levels, And what does that mean for the broader market sentiment? Because for in a lot of ways, I think both Apple and Tesla are sort of the poster children for market sentiment. And we'll see. But Tesla's not trading well. And again, it really does come down to, I think, the belief in whether you believe or not in Elon Musk. And the last couple of weeks have been difficult for him, I think, in both the public forum and in terms of his stock as well.
Yeah. All right. Well, that's it. That's why we hit on that one. To me, I think that's as
So you got to
important
look
as
at it.
any other macro asset here. And I think that, the cult around him and his involvement in all these companies, it could kind of come undone here. But again, I said this on a call that you and I were on before a year ago. If, let's say, the headline pops up on FactSet tomorrow morning at 6 a.m. that Elon Musk is no longer the CEO of Tesla, if that happened a year ago, I think the stock might have cratered 20% just on that headline. Given where the stock is right now and all the negative sentiment around him, the stock might rally 10, 15, 20% on that. So again, I think it's worth noting. It's one of the largest components of the S&P 500 and obviously of the NASDAQ. That's it, Guy. We're out early today.
I know you want to get out of here. Great Ranger win last night, down 2-zip, 3-1. Came back and won in overtime. Snipe goal, which is just great to see. They're on the right path. But that's it for Market Call. We cut it a little short today. I am sorry. I want to thank our sponsor, CME Group, where risk and fact meets opportunity. Our sponsor, FactSet, our data provider, FactSet. We'll be back tomorrow, Wednesday. I believe the great Carter Braxton Worth will be joining us. See you later, folks.
See you guys. Thanks.